Let's talk commodities. Bill Baruch's joining us. He's the president of Blue Line Futures. He is here to help us take a look at the run-up we saw in crude yesterday. Bill, good morning to you. Happy Friday. Welcome and thank you for joining us. It seems like Germany's on board with the Russian oil ban. That sent crude to 111.
Yeah, we're moving up to 111. There's a lot of resistance there. This was our intermediate term target. Been a bit of a battle last week or two, a big failure last week, but there's definitely a lot of technical tailwinds, not just the Germany news. But yeah, this is fundamental. I mean, you're seeing across the space where natural gas has had a pretty big move too. It all centering around Germany right now.
I'm hearing about these plans and how they're going to make an effort to trim the reliance on Russian oil. I guess the question I have, and we've been hearing about the infrastructure and some of the necessities in place in terms of a logistical aspect aren't really there at this point as far as like storage facilities and such. I mean, I guess, as traders, we know very well that, talk is cheap ultimately. So are we going to see some sort of a real shift here at this point, do you think, Bill? Or is this going to just be one of those kind of prolonged situations that drags on?
Well, I do think that there has been quite a tailwind in natural gas as Germany is ramping up their storage facilities or capacity and for imports. I mean, they're going to be importing it, and that's what's been a tailwind here to the U.S. natural gas, and I think overall for crude too. So I think the fact that Germany has made that move to agree with this, I believe, that's been the tailwind. It's, 111 is a big level. If we get out above 111, we could easily get to 120 pretty quickly.
We're looking at natural gas right here again this week up to $8.99, but you mentioned crude again, the 111 handle. I just pulled it up. You can see recently up to 130. That was at the peak of those geopolitical tensions. Seems like some of that worst case, Russian kind of cutting off all supplies type scenario is sort of shelved. We've talked about that quite a bit here. Talk to me, Bill, in terms of what you're seeing on the supply side. Any relief headed our way?
I don't think so. I mean, people are making sacrifices, in some places of their lives. But I think as we head into the summer, I expect demand here in the U.S. to remain very, very strong. And, now you're hearing the White House is going to be purchasing crude as well. So, I mean, there's definitely a sentiment within that's keeping the market buoyant, too. So I don't see this going away anytime soon.
How about China? Speaking of not going away anytime soon, it seems like the COVID numbers and the extreme lockdowns, while they've eased some, we're still hearing about some, drastic measures that are being taken.
Yeah, Beijing is the testing's there, and they're continuing to shut different aspects down of life, whether it's the public transportation, theaters. So it just the list keeps on getting added to as the week unfolds. But Shanghai does see a bit of a plateau and in the 7-day moving average, and that's encouraging. But I do think, and one of our narratives have been for months now, is that China's using these lockdowns advantageously, and the fact that crude hasn't fallen it really doesn't surprise me. The fact that they have continued to keep lockdowns going. China's a buyer of commodities, and we're in Cold War right now. Period. And China is going. Their 5-year plan is to hoard in energy, agriculture, and metals. That's it. I mean, that's what they're going to do.
Well, it really speaks to strength in terms of the fundamentals, as you've mentioned, and we've been discussing. When you see crude rallying like this and holding 110, holding above 100 strength that we've seen in the U.S. dollar, talk to us about any real standouts for you. What was the takeaway in terms of your guys' poll from the Fed meeting?
Yeah, I'm finished with energy. I remain bullish. We remain long, and I love being able to size positions perfectly with the way the CME has micro products. It's terrific. So whether it's micro products in the crude to micro products in the equities, and yeah, we had a nice rip higher. That's been really my major focus for the last 2 days. I'm positioned long term in crude and energy stocks, and I'm happy with that. My focus here is what I'm doing on the equity side, really for the last 24, 48 hours. and we had a nice move higher after the Federal Reserve. But 4303, as I think you pointed out here in the pregame, was a big failure, and the selling came in. It doesn't seem these days that the market just kind of finds support in the middle of the range. It's a pendulum, swings up and swings back down, and so now we're the other side of the range here, 4100. We really need to see that hold. I think that the Fed has done a really good job. I think that there was definitely some excess hawkish expectations, and they stayed in line. They stayed patient. They weren't aggressive previously. Was no reason. The fact that the market sold off from the April highs to where we are now gave them no reason to be more hawkish. And I applaud not sort of taking that 75 basis points off the table. They've been very transparent. It was not the Fed that really did this in. I think there was tailwind of news early yesterday. Again, very strong technical resistance, and but I think the Bank of England really sort of missed that punt there. And the dissenting was about 6-3. They eroded their economic expectations. They're calling for inflation at 10%. It was a very scary report coming from the Bank of England. So the market didn't like that in general. And then you had crude oil rallying on OPEC, which is also a tailwind. So the Bank of England, sort of backing off from the hiking and their sort of dovish comments was stoking inflation. Higher crude oil, stoking inflation. The announcement from the White House buying crude, stoking inflation. So you had this stoke of inflation, and guess what? The 10-year yield is going to rip back up to above 3%. And what was all things considered, a pretty high velocity move. Yeah. And that cratered the market. So there's a number of things that I think that happened there, and here we are. My theme for the past week to 2 weeks has been, I've been pretty bearish coming into this, but 4,200 last Monday achieved, saying, hey, there's measured downside. 4150 is the area. 4130 is the gap from last April. So that's the measured downside. We've already responded to that once. Makes me nervous now that if we start selling off, if that gets taken out, I've reestablished hedges in wealth portfolios. I'm sort of managing risk on really managing risk on trading longs here. But I think some of the really positive signs that we saw yesterday in the equity market, or coming into yesterday in the equity market, have eroded. Really great relative strength thrust in the Qs versus the staples on Monday. Unlike previous Monday and previous Thursday, that didn't happen, and we stalled at 4,300. The thrust that we had this Monday was very similar to the February 24th low, March 8th low, and then really with March 15th. So a lot of that is eroded. It's very you really have to keep an eye on this downside here today. I do think potential of a Goldilocks number is pretty high right now on the non-farm payroll. However, if we start getting below 4,100, I think there's going to be some negative gamma selling that this market can't avoid.
All right, 40.56, the low from earlier this week. Lastly, your thoughts on industrial metals here, because silver and copper recently weakening a little bit, kind of telling a little bit of a different story in terms of what we've seen with crude, sort of speaking to the market specifics here, I guess, in many ways.
Listen, I like gold and silver, but when you're on the precious metal side, and I think there's very limited downside in silver from here, but I don't want to see gold break 1830, 1850 would be great. On the industrial metal side, I think copper's going to have its day at some point. Again, I think copper was actually a little bit of a signal yesterday. Traded up about 440 overnight and then came down about 10, 15 cents almost, ahead of the opening bell yesterday. And that was sort of Dr. Copper coming back and telling us, hey, the rally that came from the Fed eroded pretty quickly, and that led to lower prices. So I'm definitely keeping a pulse in copper. And hey, we talk about this micro contracts. The CME has brought out micro copper. It really is there's not a ton of volume in it yet, not a ton of open interest, but we're actually actively in it right now. And it's actually I just again love these micro contracts and being able to size positions. And I'm not talking about sizing with micro contracts in a 20K account. I'm talking 6-figure, 7-figure accounts using micro contracts and get the exact size position you want. It's just a tremendous job by the CME.
Silver here now. We were just looking at copper. You can see how both have come off a bit, but are still holding at a bit of a range. And in terms of that micro copper contract you mentioned, thinly traded at this point, but that's just a matter of time if the trend continues in terms of what we've seen with some of the other products and access points that the CME's made available through those micro contracts. I'm a big fan of them as well. Bill, appreciate you joining us here. Thanks for sharing part of your Friday morning with us here. A busy morning at that, and we appreciate you taking the time out to do so. Bill Baruch's joining us here this morning, the president of Blue Line Futures.